We've had a decent sell-off in some stocks over the last few days, but I'm still not seeing any value in this market. There's some undervalued stocks like Amazon and Meta and a few others, maybe some stocks that are fairly valued, but I'm really not seeing a lot of value, a lot of bargains, any stocks that are making me want to go all in. I mean, the only stocks that I really bought outside some of the big seven is an exchange, like a stock exchange stock outside the United States for 18 times earnings. If I bought it in the US, it would be like 31, 32 times. So I haven't been buying a lot of stocks recently, but I believe there's a sector that's been really hated in the S&P 500 and the market in general, and it's getting me very, very interested. And this is mainly the software stocks. A lot of the software stocks have been getting killed over the last few weeks, down 17, 18, 20%. And I have two highly requested software stocks that I want to talk about today, and I'm very interested in talking about them again and potentially owning them. So I really hope you enjoy it. As always, the first one is CRM, which is Salesforce. I talked about it many times. I said the stock was a trap before. The stock is down 32% over the last year. It's been really terrible. Now, the earnings report has been actually great. The company has grown around 10% in subscription, 9% in revenues, and margins are expanding, and things are getting better. So it's looking really good for the company. They're also focusing a lot on agentic kind of force and agentic revenues in general, and that's also booming for them. And now a lot of people have kind of celebrated the company's annual meeting, because in the annual meeting they set a 2030 target of reaching $60 billion in revenues, which would be a massive reacceleration of 10% annual growth. That would be really good. The company was growing recently 6 and 7%. If they can grow 10% again, that's really amazing. From 41 billion in 2026 to 60 billion, that's not bad at all. But you have to know that Salesforce, back in 2022, they set the 2026 guidance of $50 billion. And here we are in 2026, their guidance is 41 billion. So they massively missed on their 2026 guidance by almost $8 billion. So should we really trust the management of Salesforce? I personally don't trust them too much. I look at the CEO, he goes on the internet, talks about Palantir, and I don't really trust them too much, and I haven't been really meeting or even beating their estimates, unlike other CEOs. And I'm not really trusting in the $60 billion too much, so I'm not really basing my estimates on the $60 billion. And again, they've been decelerating in revenues, and lately they went from 24, 18, 11, 8%, 8%. If they can get back to 10%, I really hope so. That would be amazing for Salesforce. I'm not sure if AI is going to disrupt all of Salesforce business models. I talked with a lot of smart people. They told me it will not disrupt a lot of them, some basic things, but not a lot of them. But there's some ridiculous things within Salesforce. One of them is Slack. Like, this person is paying $17,000 a quarter for Slack, for his team, and there's other ways to do it for free, and you don't have to pay $17,000. So a lot of things within Salesforce are not actually necessary, you could say, but there's other things that are necessary, and they will not be disrupted by AI. Now, if I look at the multiple of Salesforce, it came down a lot. It went from 80 times earnings to 17 times earnings. This is huge, guys. 17 times earnings is really not bad at all for a company that was growing 24% earnings per share, expected to grow 15% in 2026, 11% in 2027, and 14% in 2028. This is almost one peg ratio, or one-time price to earnings growth. This is not bad at all for a company like Salesforce, and they tend to overpay for acquisitions, but if they do one or two more acquisitions, they could potentially push it further, much more than 11 and 12 and 15% in earnings per share, potentially up to 20%. So for me, I think Salesforce over here is presenting an opportunity. It's really not bad at all. I'm personally looking into it, and I like it very much. I think it's hated, very bad sentiment, not like what it was before. And I think the 17 times earnings multiple is offering a lot of margin of safety for potential investors. The second one is Intuit. Intuit stock. This is an interesting one because, again, it was a high quality company and you should pay up for quality and all these things. Well, it's down 31% over the last 6 months. Intuit is an interesting one. Most of their revenues come from their global business solution segment, which is mainly QuickBooks. Maybe you used QuickBooks or QuickBooks Self-Employed, it used to be called. I used to use it. You could track expenses, and then you can use TurboTax and integrate it within QuickBooks. You could, for example, use QuickBooks in the United States mainly and all around the world, and you can hook up your credit card or your bank account to QuickBooks, and whenever you buy something, it gets labeled as a business expense, or if it's not a business expense, and at the end of the year, it's all labeled, this is your income, this is your expenses, and then when you go to TurboTax, which is the company's tax website, tax platform, it's linked to QuickBooks, and it just goes in there, and then you file your taxes. It's really easy, and it's actually very sticky. So I'm not sure how AI is gonna replace something like QuickBooks Self-Employed or other QuickBooks kind of solutions. I'm not really sure how that's gonna happen. Maybe the government is gonna make something like where you could file your taxes for free. I don't believe the UI is gonna be as easy and as fancy as TurboTax. It's very easy for people to use, and it saves your record. So every year, if you use TurboTax for 1 year and then you use it the next year, it has everything saved, your job, your information, everything. It makes it so easy for you instead of you switching to a government website or something else to save $20 or $40 or whatever. Most people want to pay it and they want to make it easy. So this is a big one. So most of their revenues, they come from QuickBooks. Then the second largest part of their revenues is from TurboTax, which I just told you about. And then they have Credit Karma, which is like an app. They acquired it like a few years ago, where you could pretty much go and track your credit score. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But for TurboTax, what's really interesting to me is they've been growing TurboTax Live. TurboTax Live is now 41% of the TurboTax revenues. And this is when you could speak live to a professional through a screen. You could speak to another agent, and this agent will help give you tax advice and help you throughout your application. Maybe that will be disrupted by AI, but maybe TurboTax will have an AI bot or an AI agent that will help you file your taxes. So that's also could be something to think about. Maybe ChatGPT or Gemini is not going to be able to disrupt that. Now, what has really surprised me is Credit Karma, which is an app to check your credit score, is growing double digits in revenues, 18%, and it's making 2.2 billion. I was not expecting that at all. I used to have the app before, and you can check your credit score anywhere. But it's a well-known app in the United States, and people use Credit Karma. And Credit Karma has partnerships, and they try to advertise to you auto loans and home loans and credit cards to apply for, and you're pre-approved for this, and you could apply for that. And a lot of people use it, and I was surprised, 2.2 billion for this app. That's really surprising. They believe they have a 6% penetration within a $300 billion total addressable market globally. So they have a long way to go. If we look at the multiple, it's crazy, guys. The stock used to trade at 55 times earnings. Now it's trading at 22 times earnings. No one ever thought that Intuit would get to 22 times forward earnings. I think that's a not a low multiple, but I think it's a somewhat of a low multiple for a company that has such a sticky business model, that's growing earnings per share consistently 14-15%, very sticky, is likely going to continue growing 14-15% in earnings per share for many years to come. So I also believe Intuit's undervalued. I think CRM has a much better asymmetrical bet. It's much cheaper than Intuit. It has a similar growth profile, and I think it's a better opportunity in general. And I think the cheapest kind of software stocks are Adobe and Constellation Software, which I did videos on and I talked about them many times, and you could check out my videos on my channel. But that was my update for today on those stocks. It was not financial advice. If you're interested in learning more about what I do and stocks I'm buying and I'm selling, I share everything I do in my group, and this is the link if you're interested. But thank you again for watching, and I'll talk to you in another video.